Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for August 6th of 2023. In our high frequency data that we show you from time to time, we kind of take a look back to 2019, which is kind of like a baseline pre-pandemic level. We've shown you this chart and the same data intermittently over the last several years, and you can see the degree to which we have recovered. Really, I think that pandemic period is almost in the rear view mirror now. But if we're really more focused on the month over month and the week over week changes on the far right column. And so when you look at, and take stock of the rhetoric with regard to an economy that seems to be moving along, and probabilities of recessions are going down, and people are feeling kind of better about things, and we might be in this perfect situation where we're getting inflation coming down and growth slowing, but not into a recession, and all of this rhetoric. We're hearing this fairly consistently now. But you can see the month over month data, checkpoint data for TSA and commercial flights are up. We've got hotel occupancy that's moving in the right direction. Steel production and rail car traffic still, while down, from 2019, is up over the last month and over the last week too as well. So there's a lot of things that are really trending in a positive way. We do have negative trend here over the last month in motor gasoline. We do know that with some of the changes politically going on within OPEC, that supply is apt to drop, and oil prices are on the move up again. But you can see by and large the data is relatively positive as it stands right now. Here we have retail sales looking at the kind of this dark blue line in 2023. You can see that it is below prior years, with the exception of 2020, when obviously we know what was going on then. So retail sales is something that we care about because it is a key component of consumption. And when that's weak, then we begin to kind of ponder the thought of an economic slowdown, which I think is still very much in the offing here. But this data has clearly been heretofore in other areas much stronger than you would expect. Here we have reflection from the payroll data that we got last week. Non-farm payrolls were up 187,000 in July. They were up 185,000 in June. That's a revised number. And so you look at this data, look at the trend line, look at these bars, how they're trending down. Labor's still relatively strong. We've got some labor data coming up in charts here, at least the next several charts. But labor is kind of slowing down. I mean, if you think about the average of 2022, that was about 400,000. And that's clearly not where we are. And you can see that, in this chart to some degree. January through May was also much stronger than what we're seeing now. We had 3.5% unemployment, which was fairly steady, again, near a long multi-decade low. And as we'll see here, we've got a little bit of pickup near term in productivity, and private sector pay is still positive to some degree. So even as we see maybe the change in payrolls, the acceleration, if you will, begin to turn the opposite way, there's still elements of the labor market that are still actually pretty strong. Here we have a few charts. Upper left, we've got workforce data. This is all in. It includes teenagers, and includes people that are getting close to retirement age, and we know that been a lot of those people that have just gone out of the workforce period, and that is very much in evidence here, that you see the employed level still below, and the labor force participation level still below pre-pandemic levels. However, if you transition to the right and you look at that cohort that is in their essentially their prime working years, 25, 54 years, you've got that data is looking much stronger and as a result, you can see down below the U.S. employment level is actually above the Congressional Budget Office forecast as it was in as it existed in 2020. And so, again, labor market's still pretty strong. We do see some slowing in the rate of growth, but overall, those numbers are still positive. Here we have average hourly earnings, and wages, as we know, are pretty sticky. We've got this dotted line, which represents 3.2%, which is the average of 2018, 2019 for all private, which is the blue line that you see here. You can see that there has been some deceleration in wages, but they're still, relatively strong, and they're holding in there. They're sticky, and that's the main thing that we need to pay attention to. Now, not to get all too worked up over that, we can see that level is fairly consistent with what we had, prior to 2021, but it does represent kind of a consistent inflation pressure that looks to persist for some time. Here we have average weekly hours on the left-hand side, and so those numbers are coming down. Best way to think of that is, companies that don't want to fire people, the first thing they're going to do to try to manage their cost exposure and whatnot is they're going to try to limit hours. So that appears to be at play here. So this would be kind of like the first step before actually letting people go. On the right-hand side, we've got temporary help, and we've got the recession bars overlaid, at least for the last 2 or 3 recessions, and it's a fairly consistent pattern. When you see temp employment rolling over, that's obviously a discretionary spend for a lot of people that want to expand their business. They don't want to go hire permanent workers, so they'll go hire temp help. But when their outlook begins to wane a little bit, then they tend to pull the reins back on that, and so temp hiring falls, and that's exactly what's going on now. Now, I think the real issue is, does this correlate or translate into a recession? Now, we don't know that because labor is a very important reason why we haven't gone into recession yet. But you can see these two charts show you that there is some defensive mechanisms at play on businesses trying to manage their costs. Here we have labor productivity, which is positive. I mentioned that before. Positive productivity is very beneficial to helping to rein in inflation, but you can see this number is rather jumpy. It's bounced around quite a bit, and so it's not really giving us a clear signal. There's no consistency in the productivity data right now. And, this economist rule of thumb is, with regard to how fast the economy can grow, honestly, is a function of the growth of its workforce plus factor productivity. And if you don't know what your productivity is, it's kind of hard to figure out how strong the economy is going to be. So jumpy data on productivity, but then unit labor costs we see on the right-hand side are still positive, but it is definitely down from where it was a year ago. Here we have a quick check-in on Treasury debt. We know debt loads are increasing, actually in many respects exploding. We had the debt ceiling crisis and nothing was being issued because obviously we had a debt ceiling. That was lifted and we've seen a virtual explosion as of late. And this is something that is obviously has weighed already on the rating agencies. These two things that they really cited, at least by Fitch, when they downgraded the U.S. sovereign debt rating, is this issue right here, which is the exploding debt, as well as poor governance, and both of which I would absolutely say are worth mentioning and worth including in this analysis. And you can see here, upper left, we've got Treasury debt expanded past $25 trillion in July. And the federal debt held by the public as a share of GDP is high. In fact, it's approaching levels that we haven't seen since the Second World War. And then on the right-hand side, we've got public debt and the rate by which it is expanding. And this is something that, when you think of, strong government, forward-thinking government, this is simply, spending that we're accelerating that will be owed by our children and grandchildren. And we're not alone. World debt, or global debt as it were, in trillions of dollars. You can see here this amazing rate of ascent. And I can say in both counts, the U.S. and the global environment here, this rate of gain is just simply not sustainable. And I'm not sure how this number attenuates or slows down over time, but it has to. You cannot, mortgage, you can only mortgage so much of your future before all of this and the associated debt service. Think about that too. Obviously you're borrowing money, you got to pay debt service, interest and principal back on that. And that's going to become a much bigger burden on global growth. And I just think global growth as a result of this and what's going on in the U.S., which leads the world, is going to weigh on global growth, and by association, kind of limit some of these outsized potential returns in the equity markets. Here we have the ISM number for manufacturing. This is the PMI. You can see it's still negative. In fact, I believe this is negative now for 9 straight months. And it's something that matters, I think, greatly to not only sentiment but to the overall health of the economy. Now, you could argue that maybe this is flattening out, and maybe it is. We'll find out in the next couple of readings where this trend is actually going. But for right now, anything below 50 represents contraction, and that's where we are on the manufacturing side. Here is the ISM services PMI. And so services are much more important to the health of the economy, and not that manufacturing isn't, because it is, but services matter a bit more. And you can see here that it is above 50, even though it's taken a little bit of a little fish hook down here in the last reading. But this is, I think, the mother's milk to the sustainability of this positive, economy and the sentiment that comes along with it, is that we still have positive growth within our service sector. Well, and every side has a different coin, and so this one, while we begin to think about the Pollyanna, perfect scenario lining up here, then we see data like this that reminds us that yes, not all boats are floating, and if this is a slowdown, then these are the types of things we're going to have to keep track of. We've had a little bit of a spike in bankruptcy filings. These are these are companies that are tracked by S&P Global Market Intelligence. You can see in the year-to-date through July category for 2023, we're at 402, when we haven't seen that since the year of the pandemic. So not something that I would say we've got to be alarmed about right now, but something that we absolutely have to pay attention to. Here is the SLOOS data, the Senior Loan Officer Lending Surveys, and we've shown you this several times over the last few months, and the trend is very consistent. Banks are getting tighter on credit. That will have an impact at some point on the ability for the economy to grow, because the economy does grow on credit, on leverage. Banks grow because they're able to lend and multiply their reserves, and help to expand the economy. But here, they're getting tighter. This is what the Fed wants. Slower credit growth will put a lid on inflation to some degree because it's going to limit the velocity of money. And but again, it has these impacts on GDP growth, and this type of trend will definitely limit growth in the quarters ahead. Thought I'd throw in a Texas manufacturing survey number. This is through the Dallas Fed, and I happen to actually contribute to the service sector activity index. It's a survey that I fill out once a month, and it gets tabulated in a different data series. But this is just for manufacturing, and you can see here in a kind of a positive change that we're back into expansion territory, at least in Texas, and that's a very positive sign. Texas is very important to the economy, has contributed a fairly strong percentage of the overall economic growth of the country. And there's a lot of reasons for that, but it's good to see that manufacturing index in our home state move higher. Here we have the Conference Board leading economic indicator, the index here, and we've been down for like 14 straight months. This is a chart that shows you kind of a lead time between when the LEI peaks and when you have a recession. Again, we're trying to sift through all the points and counterpoints to whether or not we're going to have a recession, or maybe just have this kind of this Goldilocks soft landing that people are talking about. And the jury's still out on that. This data here would tend to suggest that you're going to have a formal recession, and if we don't, it will certainly be without a lot of precedent, but it is possible. And but you see here the trend lines are pretty stark. I mean, clearly we're going to have a slowdown, and the market doesn't necessarily seem to be pricing that in. We've got some charts on that coming up, but here this LEI is pretty consistent in its ability to foreshadow economic slowdown. Here we have real GDP growth. This is the estimate from Bank of America, and obviously there's a lot of people out there making forecasts and predictions, and this is just one of them. I thought it was interesting to note because they're not predicting a recession, and there's a growing number of research firms and investment banks out there that have retracted their recession forecast. Now, there's other people that I have a lot of respect for, like Laura Rame, FS Investments. She is looking for that recession. So there's not a unanimity of opinion, which in most respects I think is a good thing. But I just wanted to show you this, that there's a clear trend line from where we are now to slow down but remain positive, and then reaccelerate in 2025. So here we have some data on China, and talked a lot about China and the reopening and expansion that they had, kind of a jailbreak of sorts, but then it really petered out, and we're kind of still in definitely that petering out stage for the Chinese economy. Their growth rates are coming down far below historical trend lines. Question is, what is the impact on emerging markets? Because outside of China, the emerging market space is actually not doing too badly, even though rates are moving higher here in the U.S. and the dollar kind of is holding steady. But it's important to note China because it is important to the global economy what happens there. And you can see that the containerized freight index is stuck in the mud here, and really kind of down to levels that we saw before the pandemic. Whether it's LA, New York, it doesn't really matter. It's the same chart here that we've got some slowdown in China. A lot of speculation on gold right now, and you see here on the left-hand side from B of A, you've had a pretty dramatic outflow from gold, and this kind of goes back to November, and so thought of as a hedge to volatility. Obviously, we've had less volatility this year than last year, and that has something to do with it. But and also, if you feel like inflation's coming down, gold is traditionally viewed as a hedge to inflation. So, and the bottom chart represents the real gold price in terms of ounces. And so the case is being made that we might have a near-term pullback in gold, but I still like gold as a long-term investment. Here we have the percentage of stocks that are trading above their 50-day moving average. And I think this is important to address. Well, it's important to highlight, but it also addresses an issue that seems to be resolving itself to some degree, even though overall valuations are still pretty high, meaning stocks are still somewhat expensive. But that we're witnessing greater breadth in the market, which was a real problem earlier this year. And we can see here that that over 80% are experiencing a new 50-day or are trending above their 50-day moving average. That's pretty important, and obviously that's something that we are glad to see. You can see that blue line earlier this year was really low, but clearly we can see that that more stocks are participating in this rally. I wanted to show this. This is the small caps versus the S&P 500. And something else that we wanted to see and we're looking forward to was the ability for small caps to perform better relative to the S&P 500 index. And that is absolutely the case right now. So not only are we seeing, maybe hopefully a little bit of life in emerging markets, but we're also seeing some life in the small cap names too. And these are two areas that we have certainly focused on in our latest rebalancing. So when you talk about sentiment, you look at the AAII bull-bear spread. So when that number is moving higher as it is, people are very bullish, very optimistic. In fact, where this index is right now, it's obnoxiously optimistic, almost too much so. And then on the right-hand side, you could see, faith being put into action. So people are really positive about stuff. They're going to go buy listed securities, i.e. stocks. They're going to go put their money where their mouth is and invest for their own account or whatever. And you can see that that's clearly taking place right now. So whatever you feel about economic growth slowdown, whatever you feel about maybe labor slowing down and wages and employment and business growth and whatever, whatever you feel about that, investors right now are still really excited about the stock market, and and it's going to have a real impact. And now, granted, a lot of this represents people that are trying to chase that caboose on the train that's pulling out of the station, but it is real, and it does manifest itself into index prices there. We have the dividend yield minus the U.S. Treasury yield for the 10-year maturity. And this is a pretty dramatic development. And so what this tells you is that certainly in the most basic sense that stocks are expensive. And so high prices make dividend yields go lower. And so when you have low dividend yields and then you subtract a 10-year treasury, which has actually gone up in value, we're over 4% there, then you get a fairly large negative number, and that's what we have now. And so what this is telling us too, one, stocks are expensive, but also that stocks are expensive relative to bonds. And so there's a trade, two trades that are evolving here, and it depends a lot on your which school of thought you're at right now, or you're in right now. there's a school of thought that says, hey, rates are going to continue to move higher. I want to be short uh, treasuries, meaning I want to bet that their price is going to fall. And then there's a fairly large camp out there, including Warren Buffett, who they're out there buying long dated treasuries because they think that rates are ultimately going to come down, and so they'll benefit from that with capital appreciation on the securities that they own. And I think both have some standing merit to them, but I would right now put much more emphasis on the prospect of rates coming down, not this year, but next year perhaps a little bit, but remaining somewhat sticky. But this chart here and this spread represents, I think, at least a relative opportunity in fixed income. So we've talked a lot about market valuations being expensive. This is a chart that kind of puts that into focus for us. But what's still interesting is the equal weight. We'll talk about that in a second. But first, on the far left, you got the S&P 500. Yeah, we're currently trading about 20 times earnings, and this is forward earnings. Trailing earnings, we're actually closer to 22, 23. But you can see the long-term average there, the 20-year average is about 15 and a half, very consistent. That hasn't moved for many years. But what's interesting though is if you say, let's take out the influence of those kind of high-flying artificial intelligence linked stocks, the Magnificent Seven or whatever you want to call them, then you get it to an equal weight basket that's actually cheaper than its long-term average. And so that when you get past the high flyers, there's actually a lot of embedded value, and that goes for both the S&P mid cap as well as the small cap too. That multiples are cheaper than the overall market, which is not, it's not out of the ordinary necessarily. But both of these have relative value to their long-term averages and relative value to larger cap names. We've got the US ISM number, Institute for Supply Management, uh, and that's overlaid with high yield corporate spreads. And we know that spreads have been really tight, again, owing to this optimism that seems to be out there. But when you see a divergence in this data series, as we do now, and this goes back to 1994, and you can see the high degree of correlation here over time, that when you have an ISM that is struggling like it is, and again, this is manufacturing, that your spreads would tend to have to um, uh, move with that, meaning the spreads would have to blow out, because if you're witnessing slower growth, then you've got higher risk of default, and then there should be a higher risk premium applied to those bonds, and that just hasn't happened here yet. So be a little wary of high yield at this point, based on the texture of this chart. Government bond yields. So we've been talking about how rates have moved a little bit higher, man. Kind of like kind of slow pub crawl, if you will. Going back to after the Silicon Valley Bank crisis, and then that went away because the government backstopped everything, and then we've kind of been slowly creeping higher. And this is, I think, important for savers, driving up short-term yields, which is good. People aren't having to stretch or take on a lot of credit or term exposure to get a decent yield. And it's also taking perhaps a little bit of the froth away from the equity markets that are widely perceived to have perhaps a lot of risk. But then as we've seen, there have been a lot of investors that say, I don't really care, I don't want to miss out. So they're jumping in with 2 feet. But here we've got this 10-year yield, which is moving higher, which is kind of a notable development that has been slowly playing out over a number of months here. And as a result, we have higher mortgage rates. As you can see here, we're probably somewhere in kind of in that 7 to 7.2 range. That has moved higher consistently from April. Again, following the Silicon Valley Bank dilemma there, mortgage rates continue to move higher. So we see obviously inventories, the entire supply and demand curve has shifted down. Mortgages are more expensive, so there's less demand, but there's also less supply because people are staying put. And so, this is one area that I think, will have some related impacts on the broader economy because, if housing slows down, then you lose some of that second order spending, perhaps, and this is obviously something that we need to watch. That's all we have for this week. I hope you've enjoyed the chart pack and I hope you have a wonderful week. And we will be gone. I'll be on another trip out of town this coming weekend, so there'll be no charts of the week next week. But we will come back again the following week and kind of catch up on all the news that is out there. So have a good week. We'll talk to you again soon. Bye.